We developed something called the Secure Income Score. And as you're heading into retirement, if you want to have more confidence that you're going to be okay in your retirement plan, one number you're going to want to understand is the Secure Income Score. The way that we calculate the Secure Income Score is we look at all of your guaranteed income over two people's lifetimes, and we compare that to all of your essential expenses over two people's lifetimes. So let me show you how this works within the calculator. You'll notice for this hypothetical couple, their secure income score is 93%. What this means is that out of all of their essential expenses, 93% of their essential expenses are covered by guaranteed income. The only guaranteed income that this couple's going to have is their Social Security. And in this model, we're going to assume that both husband and wife were high income earners. They maxed out Social Security. They're retiring in 2023, and they're both going to start taking their Social Security at age 62. And the maximum benefit for 62 this year would be $2,572 per person. And then we're going to assume that that Social Security benefit increases at 3% per year for cost of living adjustments. The next thing that we want to understand is their spending. And to create a very simple scenario, I have all of their essential expenses at $5,000 a month, increasing with inflation 3% every year. And then their discretionary expenses are $3,000 per month. And you'll notice those also increase at 3% per year. And we have them marked over here as discretionary. Essential means that you need at least $5,000 a month buying food and paying for the electric and paying for the garbage and paying for insurance. Discretionary means that that could be money maybe you're spending on travel or buying gifts or paying for things like Netflix. I mean, you get to decide what's essential versus discretionary. But the idea is you have the money that you need for your basic standard of living, and then you have the money that you need for the extras in life, the things that would really make life wonderful in retirement. So those are your essential and your discretionary expenses. The next thing we do is we come over to the future view. And on the future view, we are going to add up all of the income that they have, guaranteed income, because remember, the only guaranteed income they have is their Social Security benefit. And we add it all up over both people's lifetime. That's their guaranteed income. And we compare that to all of their essential expenses. Now you'll notice right now we're showing all expenses, $96,000 per year. But up here we can change this to essential expenses. And then you would see the $60,000 per year. So we want to be able to show people the difference between all of the spending they want to do versus the essential spending. But we take all of their guaranteed income, compare it to all of their essential expenses over both people's lifetime, and that is how we come up with the secure income score. So in this case, John and Nancy have a secure income score of 93%. 93% of their essential expenses are covered by guaranteed income. Now, of course, assuming that you've saved other money for retirement, in their case, you can see the withdrawal rate that they need to take out of their portfolio is 3.6% the first year. So again, coming back over here, you can see the first full year after retirement, they're going to need to take $35,300 out of their portfolio, which is a 3.6% withdrawal rate. And if you click on a row, you can see that that money the first year is coming out of the brokerage account. And if you click over here, you can see that what makes up the guaranteed income. Now, when you're pulling money out of an account that's already been taxed, it puts you in a very tax favorable environment. So you notice there's no taxes based on these first couple of years of retirement. But when we get down here to 2026 at 65, now you'll notice their spending, all of their spending is up to $104,000 per year. And we're now assuming that the additional portfolio withdrawals that they need to take are coming out of their traditional IRAs. Their money's growing at 4% per year, so now they have a 4.3% withdrawal rate that fourth year of retirement. One of the things that you can do once you create a model is you can come in and you can play around with things like, well, what if I start Social Security at 67 compared to starting it at 62? How does that impact the secure income score? You might also be interested to learn how much money you have at the end of both people's life expectancy based on when you start Social Security. You might also want to play around with things like rates of return, assume maybe a 3% rate of return, or you can use historical stock and bond rates of return to see how that asset allocation would have performed. You can use a bad timing sequence of returns within the calculator. But ultimately, what we're trying to do is establish how much confidence you can have as you head into retirement. And one way to do that is to compare your guaranteed income to your essential expenses over two people's lifetime. I hope you found this helpful.